I want to start with the issue that's on everyone's mind, tax reform, or if you prefer, tax cut. You and your colleagues have done a lot of work on this. You've analyzed it. You've tried to figure out what it means for Marathon, what it means for markets and investors. What have you concluded?
Well, like blackjack, 21 is a winning number. And for companies, 21 is a big difference. It's a paradigm shift to have a 21% tax rate because it makes companies here in the U.S. for the first time tax competitive around the world. The average tax rate around the world, industrial countries, is 23%. So you'll start to see foreign operations of U.S. companies start to shift back. With that, jobs shift back. And you may actually, for the first time, see foreign companies want to domicile here in the United States. And that is a paradigm shift, number one. Number two, it obviously drives a lot of profitability for companies if they have to pay less tax. Not for technology companies that pay less than 21% tax today, but for most of the industrial companies, telecom companies, utilities are paying these higher tax rates. Banks in particular, they'll pay a much lower tax rate. That goes right to the bottom line for these companies. So major beneficiary there as well.
So how does that change your perspective on American companies as an investor? You're a credit investor. Does that make these companies more credit worthy? Should these corporate bonds, whether they be IG or high yield, be trading up?
So this year alone, there's been $1.3 trillion in investment-grade corporate issuance. That's a record which I think will not be broken in the next decade. Why? Because companies heretofore have been able to write off or deduct their interest cost, and going forward, they won't be able to deduct the cost
in a phase-in period.
In a phase-in period. It'll take about 3 to 4 years. And so first it's against 30% against EBITDA and then 30% against EBIT. And so it's going to make it more expensive. So what companies will do is they'll take the $2.5 to $3 trillion repatriated dollars that come back to the United States. And what will they do with that money? The number one thing they do with that money is probably buy back their stock along with buy back some of their debt.
So people have not been talking about debt buybacks nearly as much as they've been talking about stock buybacks.
And we think we'll see a lot less issuance going forward on the margin, as well as some debt reduction. And that's true of investment-grade companies that have this cash that they're bringing back, as well as the high-yield companies. They're going to see their interest expenses go up since they can't deduct going forward. And so we think the high-yield marketplace starts to gradually, over the next several years, deleverage itself, which means less issuance, which also means buybacks, where companies are able to do so.
What does it mean ultimately, Bruce, if what you're describing here is that liquid markets for U.S. corporate debt are going to shrink?
Well, what I'm saying is
there's going to be less debt issued.
There may be less debt issue, and maybe that's a good thing, because maybe corporate America has become too indebted, and maybe it is not so beneficial for companies to load themselves up with debt to then go out and make a dividend payment or buy back stock with money that's been raised. And so I think it just rationalizes as opposed to sets rules that causes companies to do things that they otherwise might not have done. I think the simplification for corporate America is actually a beneficial thing for corporate America.
Is there a trade here, or if you prefer, is there an investment here? Is there an investment thesis inside the tax bill?
Investment thesis, I think, is a little bit of, a stretch from this point going forward. I think the equity markets have already responded because NASDAQ stocks are up 30% this year. The
Dow's at almost 25,000.
25% this year alone. And I think the market's gotten maybe a little bit ahead of itself. Having said this, this is very, very beneficial for corporate America. So it's good for stocks, maybe not so good for bonds, because we think growth will be accelerated. Growth was already coming in 3% GDP and maybe boosted by another 1% to 1.5% GDP in these next couple of years. And so we think the Fed will be more aggressive in raising rates going forward. And so LIBOR will be going up in relation to the long end. And when LIBOR goes up in relation to the long end, the yield curve flattens, number one. Number two, higher rates. Yes, that has implication for bond prices going lower. And the money coming back, buying stock, paying out dividends is beneficial for equities. So is there a trade here? Yeah, it's been a massive trade, and this massive trade will now begin to affect interest rates.
You've also done some work on the dollar.
Yes.
Now, you're not a Forex investor per se, but you think about currency markets because you have to hedge some cases when you're investing outside the United States. What do you think it's going to mean for the dollar, this tax bill?
Well, very interesting. The repatriation of this $2.5 to $3 trillion, not all $2.5 to $3 trillion comes back. What comes back? Maybe 75% of that. So let's round the number to around $2 trillion. Just say $2 trillion comes back. Out of that $2 trillion, about $1 trillion is being held offshore in dollars, and about $1 trillion is being held in other currencies, like the euro, the yen, or other currencies where they've been dealing. That $1 trillion that's in other currencies, with the $1 trillion comes back, which means the $1 trillion in other currencies creates this big bid for U.S. dollars.
How big a bid?
And that bid is a pretty big bid, because if you look at 2004, when Bush also provided for repatriation of money coming back, we called it amnesty back then, when the money came back, the dollar rallied 13% that year. And I'm not saying it's all due, that rally was all due to the repatriation of that money, but a good part of it was. So with $1 trillion coming back, we think the dollar will be the #1 major market currency for next year against euro and yen.
Do you think it'll rally 13%?
10% plus.
Really,
Yeah.
you see the dollar up 10% plus against the euro and the yen?
In 2018, because of this money coming back. And this is not coming back in 2020 and 2021. It's coming back next year.
Now, what are the implications for emerging market currencies? Because that's a place you are active.
Well, I think emerging market currencies will remain vibrant and not necessarily give up much versus the dollar. Here's the thing with the emerging markets, Eric. So #1 is all 45 countries in the OECD this year are growing and growing at a nice rate. The last time we've seen all 45 countries grow in the same year, you have to go back over a dozen years, and that trend continued for years. So #1, growth is good for emerging markets. #2 is the commodity cycle has begun to turn up, and this is also very positive for emerging markets. And so emerging market equities have been the top equity performer this year. Everyone is underinvested in emerging market equities. So when you look at next year going forward and where you're reallocating capital, a lot of people that chase returns are going to say, hey, I'm underinvested in emerging market equities. Let me put some money into the emerging market equity marketplace. So I think for all those reasons, plus a few others, emerging markets generally is going to have another positive year next year and do quite well.
But you're not an equity guy, you're a credit guy.
And with that, their currency will be relatively strong.
Okay.
So the big currencies that I think are the vulnerable ones are the euro, the sterling, and the yen relative to the dollar, not necessarily the emerging markets.
Okay, Bruce, we don't want to call it an emerging market, but it often looks like one. Puerto Rico. Your firm is heavily invested in Puerto Rican debt. According to court filings, you have in excess of $600 million in PREPA and general obligation bonds.
We have no GO bonds.
You have no GO bonds now.
But PREPA, we have a big position in PREPA, that's correct.
And some other bonds.
And some other bonds, like PRESA, the Water Authority.
So Puerto Rico, hammered by the hurricane, these bonds are trading in the 30s. The market is telling us that's where the recoveries are. What's your view, and how long is it going to take?
Well, I don't think the market's telling you that's where recovery is, but that is where the
market
is. They're trading in the mid-30s. And so, listen, between Irma and Maria, it was the 1-2 punch, but Puerto Rico is a proud country, a proud state, island, Commonwealth, and Puerto Rico will do well. It will come back. And FEMA's down.
Hang on a second. Puerto Rico comes back means those bonds are money good, 100 cents on the dollar?
I'm not saying they're money good. So FEMA is down there, and the Army Corps of Engineers is down there, and the power is now 75% restored, and we think in the coming months will approach 80 to 90 and then be fully restored. The issue with PREPA, I think, because only 1/8 of the cost of PREPA is its interest expense or its bonds. 7/8 of it is its operations, how it secures power and how it distributes power. And so I think what PREPA really needs is they need to build their own liquefaction plants and be able to be more efficient in energy. And I think they will get to that. It just needs more of an investment, and we're willing to make that investment, and that's why we're there.